Of the 36 income investments that pay me an average yield of 11%, these 27 pay monthly and these 9 pay quarterly. Getting paid monthly seems better than waiting an extra 2 months to get paid, so do these 9 really matter? Well, this one beat the S&P 500 over the past 30 years by 1,000%. Today we'll look at these 9 to help you decide whether income investments paying quarterly are worth the wait. The list of 9 isn't random. They fit into 3 groups: 6 BDCs, 2 preferred shares, and not a partridge in a pear tree. The last one is an equity fund. Most business development companies, or BDCs, pay quarterly. Here are 5 individual BDCs that I currently hold. If you're not familiar with this sector, those yields may look high, but they're fairly typical. These are private lenders that distribute most of their returns as income. This interview with the PBDC fund manager Mike Petro explains how they work. The income is fairly consistent, as you can see from these distribution charts. A lot of BDCs also pay special dividends when the income is higher than expected. So if you hold BDCs, the special dividends can be a nice surprise. Total return combines price and distributions and gives us a good snapshot of performance. 4 of these 5 have been around for at least 10 years, and we can see that with the exception of CSWC, they've all beaten the S&P 500. And CSWC was pretty darn close to catching the S&P 500. Now, to clarify, these are all lenders, so the S&P 500 isn't an apples-to-apples benchmark, but it's a yardstick that we're all familiar with. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Blackstone's BXSL wasn't on that chart because it's only been around since October 2021. This chart begins when BXSL was launched, and so far it's held its own, outpacing the S&P 500 over that almost 4-year period. That's 5 individual BDCs. If you don't want to research BDCs, you can just buy a fund that specializes in BDCs. PBDC is the one I hold, and it was launched in September of 2022. Interesting side note, the biggest BDC fund by far is BIZD, with assets under management of $1.6 billion. PBDC is much smaller at only $236 million, but has outperformed the big dog. That's mostly because of active management, and there's an excellent comparison of the two in this analysis by Reader's Digest on Seeking Alpha. If you want exposure to BDCs in one fund, then I suggest reading that article. I'll link it in the description, along with a link to a free trial and a discount for Seeking Alpha's premium membership. I check every income investment on Seeking Alpha before buying or selling. PBDC recently dipped slightly below the S&P 500 for total return, but you can see that it's easily kept pace for most of the time. As I mentioned before, PBDC is a basket of business lenders, and the S&P 500 is dominated by tech growth stocks. I think the ability of these lenders to keep pace with growth stocks is impressive. The other advantage of this or any fund is that it holds more BDCs than I'm ever going to track. In this case, 22, so you get some diversification. One more side note, the expense ratio on all BDC funds looks insanely high because of an SEC regulation that requires them to count regular business expenses as fund expenses. I'll link the full explanation in the description. The actual management fee for PBDC is disclosed in the summary prospectus, and it's 0.75%, which is reasonable for a small, specialized, actively managed fund. So 5 individual BDCs and 1 BDC fund that I like, but you can't own if you insist on only monthly distributions. However, there are a handful of options if you're married to this monthly thing. Main Street Capital is the most famous example, currently yielding 5.9%. The yield is far lower than other BDCs because its stellar performance has created tremendous demand for the stock. It has a long history of consistent income and price appreciation, so this is an example of an excellent monthly payer, but the yield is low and the price is high. Here's the opposite. Horizon Technology Finance has a higher yield, some would say too high, at almost 19%, and the price has been headed in the wrong direction. This 5-year total return chart sums it up. Main has been a superstar, and Horizon had, well, a nice little run for a while, but lately it's been a dud. I have a small allocation to Main and would love to load up on it during the next pullback. I don't hold Horizon. There's plenty of demand for monthly payouts, so why don't all BDCs just switch over to monthly? The main reasons are, first of all, their income comes from customized loans that vary based on things like interest-only periods and lump sum payouts. It's more efficient to reconcile those variations when they prepare their quarterly financial reports. Quarterly reports that are required by the SEC. And lastly, to ensure compliance, the board of directors will need to review an internal valuation of their loan portfolio before approving a dividend. The bottom line is that it can be done, but it costs more time and money to do all this 12 times a year rather than 4 times a year. These two preferred shares also pay yields that fit into my 8 to 12% range, but they won't appreciate much, if at all. So why bother with their quarterly payments? This total return chart explains what's special about them. Compared to most other investments offering decent returns, they're less volatile. DX in particular was steady Eddie during the tariff sell-off. Volatility is part of investing if you want decent returns, and I don't mind it. But in this case, I want the option to sell something during a downturn and scoop up some deals. Preferred shares like these are callable, which means the issuer has the option to buy them back at $25. For that reason, the price won't go much higher than $25. At almost $26, they're pricey at the moment. Both of these preferred shares were issued by mortgage REITs. They pay much higher yields than regular equity REITs like Realty Income because they don't hold real estate, so they're far riskier. I've dabbled in them in the past a few times, but for the most part, their common shares are too risky for me. Now, there's still some risk in the preferred shares, but far less than the regular common shares. If a mortgage REIT cuts the dividend by 30% on their common shares, the preferred share dividend won't be affected. The issuer would need to completely hold all common dividends before even considering a change to the preferred share dividends. Also, the common dividend amount is whatever the board approves, whereas the preferred share dividend is defined when it's issued, so it's far more predictable. You can also access preferred shares via a fund like PFFA and get paid monthly, which is something that I also do, but they use leverage, so the volatility will be higher. If you want to learn more about preferred shares, I'll link to this 67-page guide to preferred shares that was prepared by the REIT Forum, and that is currently free. And if you want to put together your own portfolio of preferred shares, I'll link to a discount for systematic income investing. I get a lot of preferred share ideas from their detailed analysis. Last but not least is an equity fund with the ticker ADX. The distributions recently became a lot more consistent. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. The yield for ADX is just over 8.5%, but it can sometimes go higher than that. Check out this total return chart going back 30 years. In this case, the S&P 500 actually is an appropriate benchmark because this is an equity fund. They actively manage about 100 large-cap US stocks, and based on their long-term performance, they're really good at it. When I say long-term, I mean really long-term. This fund was launched in 1929 and survived the Great Depression, World War II, and all the more recent disasters that we're somewhat familiar with. Ironically, I avoided this fund for years because the distributions weren't frequent enough. Technically, they were quarterly, but they used to pay out these tiny 5-cent distributions each quarter. Then the real distribution came out each December. That changed in 2024, and now they've evened out their distributions to the mid-40s each quarter. There's still a special distribution in December, but it won't be so dramatic going forward. If the distribution remains at the level of the August 2025 payout of 46 cents, that would annualize to a yield of 8.6%. If there's any special distribution in December, it would bump the yield higher than that. If quarterly distributions were all paid at the close of the financial quarter, it would make your monthly cash flow lumpy. In reality, it's actually not that bad. For the 9 quarterly distributions that we've covered today, 5 of them pay their quarterly distributions each year in March and 4 pay in April. So in this example, you get paid in March, then April, nothing in May, then the March group pays in June and the April group pays in July, etc., etc. Even though these 9 income investments aren't the majority of my portfolio, there's no way I'd consider giving them up based on a requirement to get paid monthly. If you've been excluding quarterly payers, that's fine, but my question is, at what cost? Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews based on my top 10 holdings. That wraps it up for this look at monthly versus quarterly distributions. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.